buy a cup of coffee, do you ever wonder about the business behind that cup? Do you ask yourself how many cups like this the company sells a month, a year, both locally and internationally, and how much money it's making by doing so? These are great questions to ask if you're an investor thinking of getting into the coffee business yourself, a senior manager, or a business learner. My name is Lyubman. I'm a university professor of business strategy and e-commerce. Today we're going to dive into Starbucks, which is the largest coffee chain in the world. We're going to take a look at their annual report to shareholders to understand what drives performance of this company and also to get some valuable insights about the coffee industry overall. Let's get started. The first question we want to ask is how many stores does Starbucks have? By looking at their annual report, we find the number of Starbucks coffee shops as well as some interesting breakdowns. First, we see that the total number of stores that Starbucks has globally is a little over 38,000. And then we see the split between North American and international stores. Here it shows that in North America, Starbucks has about 17,000, almost 18,000 stores, and internationally over 20,000. Starbucks' global network of stores is one of their most valuable assets because, as they say themselves in the report, stores are typically located in high-traffic, high-visibility locations. Starbucks is known to have the patience to wait for the perfect corner spot to become available and to adapt design to fit all kinds of spaces. And this way, over the years, it has built a valuable network of prime locations worldwide. Here we can also see the split between the company-owned stores versus the stores Starbucks licenses out. There is a strategic reason to have these two types of stores in the mix. But first, let's look at the numbers. We see that in North America, Starbucks owns 60% of its stores and licenses out 40%, while internationally, the percentage of licensed stores is slightly higher, at 56% versus owned 44%. There is a reason why Starbucks prefers to own a significant portion of its stores, even though the costs of operating stores are much higher than licensing, as Starbucks must pay rent, electricity, salaries, and other operating expenses. By contrast, in licensed stores, these expenses are incurred by licensees. This strategy is different from many of its competitors like McDonald's and Second Cup, who expand mainly through franchising and don't carry as much of operating costs associated with owning stores. The reason Starbucks works this way is because this lets it keep some control over the quality of customer experience in the stores and helps it preserve its premium brand image. By contrast, when Starbucks licenses out, it gives up some of this control in exchange for licensees investing and carrying the financial burden of running the stores. As we can scroll further through the report, Starbucks is telling us that the company-owned stores contribute 82% of the annual sales, while licensed stores contribute 13%. This makes sense because from licensed stores, Starbucks gets only royalties, a percentage of sales, while in its own stores it keeps all the revenue. In the report, Starbucks states that licensees are responsible for operating costs and capital investments, which more than offset the lower revenues we receive under the licensed store model. This way, the company has a balanced portfolio of company-owned versus licensed stores and reaps the benefits of having both. On the one hand, significant enough control over the brand image and customer experience in the store, and on the other, growing at a lower financial risk through licensees. Another thing to note is that when expanding internationally, it's not always possible for Starbucks to own its stores. This is because some governments restrict foreign direct investment, and the only way for Starbucks to have presence in a country is to either partner with a local company or license their concept fully to locals. This also explains a higher percentage of licensed stores internationally. As we look further through the report, we see that the biggest geographic markets for company-owned stores are the US, Canada, and China. It's worth noting that in China, Starbucks owns all of its stores, no licensing. As for the licensed stores, we see here that the biggest geographic markets are the US, Korea, Latin America, and the UK. Further on, Starbucks also talks about building omni-channel presence, meaning they work to offer a combined online and physical purchase experience to customers. For example, a customer can place an order for Starbucks coffee through their mobile phone and then come and pick it up in a physical store. This omni-channel trend is not only specific to Starbucks. All retailers nowadays are working to serve customers through omni-channel for convenience. The next thing that is interesting for us to note is the Starbucks sales mix, and we find that 74% of its sales comes from beverages, 22% from food, and 4% from selling ready-to-consume products such as instant coffee, bottled beverages, and other pre-packaged goods. Later on, they also talk about selling coffee products outside of Starbucks stores through partnership with Nestle, who distributes prepackaged products for them to supermarkets through the Global Coffee Alliance. It makes sense for Starbucks to work with Nestle as a partner to develop this channel because Nestle has a huge distribution network and relationships with supermarkets, which Starbucks itself is lacking. The next question we want to ask is in how many countries is Starbucks present? Here they tell us that they operate in 86 markets globally. There are strategic reasons for geographic expansion. Starbucks tells us that they're highly dependent on the North American segment. 74% of Starbucks sales comes from North America, which represents a risk. Because if the economy in the US takes a downturn, it will have a major impact on Starbucks' financial results. Since Starbucks is in a premium brand category, buying its coffee is considered to be discretionary spending by consumers. Discretionary spending is the first to get cut when people lose their jobs, have to deal with the high interest rates and inflation. In these situations, consumers tend to switch to less pricey competitors. We've already seen this happen during the Great Recession of 2008, when even loyal customers were cutting their spending on highly priced Starbucks coffee and were switching to cheaper competitors like McDonald's. Starbucks is still subject to this risk, and they have to keep economic conditions on their radar at all times. So there is a need to mitigate the economic risk in North America by creating presence in different parts of the world. In particular, these days Starbucks is putting a lot of focus on China. As we have seen earlier, China is one of the largest geographical markets for Starbucks, where 100% of the stores are company-owned. However, operations in China carry their own set of risks. In particular, in this report, Starbucks talks about strained US-China relations, creating an uncertain future for Starbucks operations in China. Also, there is a threat of new Chinese competitors to specialty coffee, plus there's always a risk for government regulations to change in a way that restricts Starbucks' ability to operate the way they want there. Also, Starbucks talks about China representing well-known privacy and security risks that may negatively affect the company overall. Apart from China, operating internationally in general carries its own set of risks for Starbucks. One of them is the currency exchange risk, which may negatively impact Starbucks' financial results. Furthermore, Starbucks talks about rents being higher in prime locations internationally and the overall higher costs of operating stores in some parts of the world. There is also a consumer taste risk, as not all regions in the world are equally receptive to Starbucks products, which may hinder international expansion plans for Starbucks. Starbucks also admits not being able to control the cleanliness of water in international locations run by licensed stores and the quality of food, which may cause a spread of disease, in which case consumers will of course blame Starbucks, and it would hurt the brand and sales. What other challenges does Starbucks face in the coffee industry? These challenges are true not only for Starbucks, but for all players in the industry. One of the risks Starbucks is subjected to is high volatility in coffee prices. Here they say, although most coffee trades in the commodity market, high-altitude Arabica coffee of the quality sought by Starbucks tends to trade on a negotiated basis at a premium above the C coffee commodity price. So because of Starbucks' commitment to quality, their input costs are higher than they could have been. Then they go on explaining that many factors can affect the supply and prices of coffee, such as weather, water supply, natural disasters, crop disease and pests, as well as political and economic conditions. And then above, they talk about how Starbucks controls buying of its own coffee, meaning it doesn't rely heavily on importers or distributors. This means that they are saving costs by passing intermediaries, and also thanks to the large size of orders they place with suppliers, Starbucks can get coffee beans at lower prices. Starbucks also takes care of roasting its own coffee, which contributes to a unique taste and drives back to the idea of controlling quality. Another challenge that Starbucks is facing is the availability and the cost of labor. As Starbucks is expanding and opening more stores, it is facing difficulty finding enough human talent to staff these stores. And even though Starbucks is known for offering competitive wages and benefits, those costs have also increased. They mention that there are many more opportunities now for employees to find telecommuting jobs, so Starbucks now has to compete with these offers when trying to hire employees to work physically in their stores. Here they also talk about their workforce unionizing, which means less flexibility for Starbucks management to make decisions in the future. There are also competition risks. Starbucks says in the US, the ongoing focus by large competitors in the quick service restaurant sector, they mean companies like McDonald's, on selling high-quality specialty coffee beverages could lead to decreases in customer traffic to Starbucks. Further on, they say, not all of our competitors may seek to establish environmental or sustainability goals at a comparable levels to ours, which could result in lower supply chain or operating costs for our competitors. In other words, Starbucks is at a cost disadvantage, trying to be socially responsible, which it should because of its size, visibility, and impact on the world, by pursuing such initiatives as reducing carbon dioxide emissions, reducing the use of plastic, and so on. Nonetheless, despite higher costs, Starbucks must continue being environmentally responsible, otherwise its reputation can be attacked and the result would be even greater financial losses. Now let's look at the income statement of 2023 and see how much money Starbucks makes. First, we look at the sales at the top. It's split between company-owned stores versus licensed stores. As we discussed earlier, revenue from the company-owned stores is much larger, and it was at $29 billion in 2023. In addition, licensed stores brought in $4.5 billion royalty revenue mostly, and then we have other revenue of $2 billion that comes from distribution of packaged products through partnership with Nestle. This brings us to a total of almost $36 billion in sales Starbucks made in 2023, which is an increase compared to previous years, so it looks positive. But it's too early to celebrate because if we take a look at the operating expenses line, it chopped off $30.5 billion from Starbucks sales. A big part of these expenses, over $11 billion, as we see above, is product and distribution costs. In other words, the cost of coffee beans and other inputs and their transportation to and between the stores and roasting plants. Another big part of operating expenses, over $14 billion, is running the stores, which includes rent, electricity, salaries of employees, and so on. And if we want to see the percentage split of expenses, we can scroll above and we see here that product and distribution costs represent almost 32% of sales, while operating stores costs almost 41% of sales. So in the end, almost 85% of the sales generated by Starbucks goes to cover operating expenses. Now, going back to the income statement, we see that after deducting all expenses, Starbucks was left with $5.5 billion of earnings before income taxes. Then it had to pay the government $1.2 billion in taxes, so the profit of Starbucks for 2023 was $4.1 billion. If we are to calculate the profit margin for Starbucks, 4.1 billion over 36.5 billion in sales, we end up with 11.5% profit margin. Now you know how much Starbucks made in its fiscal year 2023. Now, what are the plans for Starbucks going forward? What can we expect from the company in the future? In the annual report, they talk about the reinvention plan, which mainly includes building their leadership position in coffee. So despite expanding into other products to a smaller degree, Starbucks still sees itself mainly as a coffee authority going forward. They are also planning on disciplined global expansion, which includes experimenting with new store formats such as pickup and drive-through. So we should see more of Starbucks stores opening in the future and not necessarily in formats that we're used to. Going forward, they will also be focusing on digital relationships, including mobile and other digital capabilities, to ensure convenience for customers. What I found interesting is that they are seeking growth across all day parts, including lunch, because as a coffee company, most sales happen at Starbucks in the morning. Covering more day parts like lunch will expand Starbucks' sources of revenue and will make it more competitive against fast food chains that are already doing so. They are also talking about cost reductions, but at the same time being an employer of choice, attracting employees and training them to deliver the best customer service, which means cost increases. So these are the things that we can expect from Starbucks in the future. And now you have a good appreciation of what it's like to be a coffee retailer in today's world, and what challenges and risks you have to deal with, and what the costs and profits could be. And if you're thinking of investing in Starbucks, I hope you got a better understanding of this company's value. Please let me know what you think of this video in the comments. And if you found it useful, please click like and subscribe so you can get more videos like this one. Till next time.